Hey, high yield dividend warriors! A lot has changed since February 19th. The day of liberation has come. The stock market has absolutely crashed, despite what many of the high yield dividend warriors were saying before, that recessions, that they never happen. Well, I wouldn't say we're necessarily in one yet, but the way that these tariff talks are going, we might be looking at one real soon. Speaking of the high yield dividend warriors, has anybody seen their leader lately? Many cults end when they drink too much of the Kool-Aid or get deported and then get secretly killed by their followers. But the leader of the high yield dividend warriors seems to have taken a break because the US military apparently told him to do so. That's right. The high yield dividend warriors were shut down by the US military. That was the only force that could stop the warriors. But it also just happened to coincide with what was the biggest stock market Armageddon in the last 5 years. That likely margin called their leader, most of the warriors, to the extreme brink. I have a feeling we have not yet seen the last of our favorite high yield dividend warrior, assuming he hasn't yet fled the country. Now, while many of us will recover just fine because we have high quality investments, the warriors, they're going to be struggling to recover. Thankfully, the top income ETFs that we're going to be taking a look at today, they will probably go up, and that means your money may actually grow. So what are some of the criteria that we look at when ranking these income ETFs? Well, we're going to be putting extra emphasis on their performance since February 19th. That was the last time that I did these power ranking videos. Remember, power rankings puts extra emphasis on recent performance because it's all about what have you done for me lately, not always what have you always done for me. And of course, we're going to be looking for no NAV erosion. Now, NAV erosion, as you're going to see in this list, has been everywhere just because the stock market all around the globe has been down. So it's a little bit understandable that stock prices, ETF prices are going to go down as well. And just in the long run, these stocks should be going up. We don't invest in these for capital appreciation. It's mostly for those sweet, juicy dividends. And then, of course, we should be getting real dividends or distributions. They should be coming from the profits that these income ETFs are doing on their options trading. It should not just simply be your own money returned to you under the guise of a dividend fugazi. This is when the companies are just returning your own money back to you. We don't want any dividend fugazis. So let's start off with some of the honorable mentions, some of the ETFs that just missed out on the list. We're going to start off with the RecShares FEPI and AI Pi. These two ETFs have unfortunately had quite a bit of NAV erosion in recent weeks, as have basically everything else in the stock market. So you can see they're still aiming for that 25% distribution yield, owning big tech, doing covered calls, but we can see they're really headed the wrong way here in their total distributions. They used to pay out close to $1.20 in dividends every single month, and that has been depleted all the way down to 94 cents. It's going to be a similar story with AI Pi, but we can see here since their launch in October of 2023, it's just continued to go down and down. They're now down 27% since their inception. Definitely not a good sign to see. Okay, a fund that I've never talked about is this new NEOS product. NEOS puts out some of the best income ETFs out there, and this one is pretty interesting. I might make a video about this. If you guys want to see more about IYRI, let me know in the comments. It's called the NEOS Real Estate High Income ETF. You can see they give close to a 12% distribution rate. And this is going to be one that gives you exposure to the US Real Estate Capped Index. Boy, what an interesting index name. It's called Capped. They're going to give you high monthly income and potentially some equity appreciation as well. Love to see it. You can see this fund is relatively brand new. It's only been around since January of this year. It barely has $30 billion in assets under management, and the dividend is still coming out there. It'll probably be close to around 12% once we give it a full year. It's had a little bit of a pullback here in recent months, but it's definitely nowhere near what we're going to see on this list. Another honorable mention is the Curve ETFs. The biggest one here is TSLP here at $16 million in assets under management. This is becoming more and more popular in our space, but these are still relatively not super popular. So we can see since February 19th, TSLP is down 36%. And then their other really popular one, KQQQ, is down 23.56%. So definitely treaded in the wrong direction, but we're going to see that's very common for these funds. All right, guys, before we make it to the actual top 10 list, make sure you let me know what income ETFs you like, because there's just so many out there. There is no way I have enough time to research and look at all these. That's why I rely on your guys' comments. So be sure to let me know in the comments what ETFs, income ETFs that you like, that you want to see higher or lower on this list. Number 10, T-SPY Tap Alpha. All right, guys, this is a fund that is looking for income today and growth for tomorrow. Ooh, what a great combination here. It's powered to get some of those returns from the S&P 500 and, of course, get that juicy income generation. It's got different objectives here, whether that's growth, income generation, time decay, reduced time risk, and, of course, that flexibility. You can see a little bit more about their trading strategy right here, but they're going to be doing call options that expire the same day. So we've been seeing a lot more of these 0 days till expiration types of funds. Distribution rate is around 14%, which is super juicy. Assets under management, about $32 million. And of course, they have an expense ratio of 68 basis points. Not super cheap, but not super expensive for actively managed either. T-SPY since February 19th is down nearly 19%. Ooh, it's rough. It's rough out there for a lot of these ETFs. We just have to hope the recovery is even better. Number 9, QDPL. Pacers ETF. All right, so this is one that broke through and is making the top 10, is this Pacers ETF. This is a large cap dividend multiplier 400 ETF. The objective is to provide cash distributions equal to 400% of the S&P 500 ordinary yield in exchange for some exposure to the overall performance. So it's getting a mix of those dividends and capital appreciation. Has a pretty good 4-star rating from Morningstar. The yield isn't super high, just under 6%. But since this fund has came out nearly 4 years ago, other than this most recent pullback, it did actually have positive returns so far. So actually, since February 19th, it is down 17%. But if we added that back in there, they'd actually be plus 14% prior to this most recent tariff wars, trade wars talk. So you're getting a smaller yield here, slightly lower expense ratio than the T-SPY that we've just looked at, just under $1 billion in assets under management. It's consistent. It's been a consistent dividend payer here, as you guys can see, quarterly dividends on the regular here. Love to see that they're being consistent around that 52-cent mark for the past 4 years. Number 8, XDTE QDTE Round Hill. All right, I'm sure some of you are surprised that I would include this Round Hill duo in here after I totally destroyed their other income ETF, XPay, in one of my most recent videos. XPay is one that literally will tell you that they are paying you back in your own money. XDT and QDT should be a little bit different. They're actually doing some options trading. They're doing the 0 days till expiration options on the S&P 500, the NASDAQ 100, and that should be generating them some income each morning by selling out of the money 0 days till expiration calls on the index. Remember, it's all actively managed, XDTE, QDTE, whether it's on the S&P 500 or the NASDAQ 100, and they are giving some juicy dividends, around a 24% distribution rate for XDTE, and best of all, it pays weekly dividends. Of course, when you get paid dividends, doesn't really matter as long as you can budget correctly, but does have that potential to give you some big income. Unfortunately, we are starting to see some pretty serious NAV erosion with these funds. So XDTE is now down 22%. But since February 19th, XDTE is down negative 19.76%, and QDTE is down 23.86%. So these are two funds that have had a really rough past couple weeks. Number 7, QQA Invesco. All right, let's talk about the Invesco Triple Q's Income Advantage ETF. This is one that gets exposure to the NASDAQ 100. They do options trading, and they give you some downside protection and some upside participation. They should be giving you around a 12% yield, so almost close to a 1% return every single month. That's if everything goes well. Of course, that's never guaranteed. I have personally been buying more and more of QQA. That's probably been why it's been going down a lot in recent times. So since our last update, this fund went down 19.67%. Of course, that's very disappointing, but again, the overall market is just totally tanking, so I don't blame these income ETFs for going down. They're just tracking indexes. They're just tracking the market. This is to be expected. So QQA has not been around too long, July of 2024. So it's almost a full year old. It has a really low expense ratio of just 29 basis points. Should be giving around that 10 to 12% dividend range in a full given year so far, and it's slowly accumulating more and more assets. Invesco is one of the biggest financial companies in the world, so I wouldn't be too worried about them. And another bonus here is that through June, they actually have a 0% management fee. This is a way to entice people to park their money into QQA, get more and more people on board. Number 6, QDVO, Amplify Growth and Income ETF. So I just made a video about this ETF just a couple of weeks ago, so be sure to check that out if you want more information on it. But this is also one that will be around for a full year once we hit August. It has 53 different holdings in it, about $28 million in assets under management. So they're going to be a little bit more selective in the companies that they're owning. And then, of course, doing the covered calls. They're going to be owning companies that pay dividends. And, of course, they're hoping to avoid volatility during times like this when the market is overall declining. So this is actually a good test to see, are these funds actually less volatile than they always advertise? So QDVO is actually only down negative 17.55%. So of course that still sounds like a lot. That's actually one of the lowest on this list. So we can see their most recent dividends have all been pretty stable, from 19 cents to 20 cents to 21 cents. Love to see it. Hopefully continues this pattern here. Again, the fund hasn't been around for too long. It's of course experienced some NAV erosion after this most recent tariff trade wars talk, but I do expect it to go back up once this is all resolved. Number 5, iSpy IQQQ ProShares. All right, this is the NASDAQ 100 High Income ETF and then the S&P 500 High Income ETF. So they are selling call options every single day, and they are producing what should be high levels of income that they can pass off to us, the shareholders. Of course, whenever covered calls happen, they are only getting some of that upside, right? That's what you're giving up, is that you're not going to get that full upside. And that's what a lot of income investors should be kind of scared about right now, right? So we've seen the big swing down. Most of these have basically next to no crash protection, so they're going to get all that downside. But the scary part is if the stock market has a super fast recovery, that's if these stocks just zoom back up, that would actually be the worst thing for these income ETFs, because that's going to blow past their strike prices and they're going to miss out on all that upside and all that appreciation. The best case scenario actually is if the stock market has a slow rise back to the top. So that's what we're going to be rooting for. So iSpy was down negative 18.17%, and then iQQQ was down a big negative 22%. So they've taken quite the hit here. All right, let's just take a look at their most recent dividends. So in February, they had 32 cents, then it went to 17 cents, and then their most recent was 90 cents. So again, this is one thing I don't like about some of these ProShares products, is that dividends are totally volatile in terms of how much you could expect the distribution to be. That makes living off these extremely hard to predict when it just seems to be the luck of the draw, however ProShares is feeling that particular month. That was for iSpy. For iQQQ, it's also pretty volatile here. So it's 45 cents, then 28 cents, and then it was 90 cents. So again, big fluctuations in how much they pay every single month. I don't like that. If I'm living off these in retirement, I want them to be somewhat consistent, so that way I can plan and for my living expenses much better. Number 4, Bali iShares Advantage Large Cap Income ETF by BlackRock. All right, so Bali, another covered call ETF. We can see here they have 203 different holdings. They have a lot of technology companies, a lot of financial companies, a lot of companies that you recognize here, Microsoft, Apple, Nvidia. They're giving a dividend of around that 7 to 9% range every single year. Ideally, if they can continue this up. They've been around for a little bit of time now, October, September of 2023. So coming on almost 2 years, about a year and a half now. Pretty low expense ratio for an actively managed ETF here at 35 basis points. So it's going to be $35 for every $10,000 invested, what I really like right now is Bali, even after all the market volatility that we've had in the past couple weeks, Bali is still up since their inception. They're probably one of the few funds on this list that can say this. So they're actually up almost 5% since they were launched. And in the past, since February 19th, they are down 16.6%. So prior to this, they were actually up around 22, 23%. So that's pretty impressive for sure by Bali there. All right, looking at Bali's dividend history, we can see they've been paying monthly dividends for quite some time, ever since they were launched. Monthly dividends coming to their shareholders' way. See, it's 18 cents, 22 cents. Their most recent dividends have been 17 cents, 21 cents, and 25 cents. So pretty consistent there. Seems to be in a slightly upward direction. So I love to see that by Bali. I personally have been adding more and more shares of Bali in my income portfolio. If you guys want to see my full $200,000 plus portfolio, see all my many positions in there, make sure you guys check out the Patreon link below. Number 3, SPY QQQI Neos. I must say I really do like this new layout that Neos did to update their website, and they also put out some spectacular funds. So SPY giving a distribution rate close to 12%. QQQI should be slightly higher, around that 12 to 14% range. And they just keep putting out these banger of ETFs, so slightly higher expense ratio and a little bit of volatility these past couple weeks, as to be expected. So SPY was down 16.88%, and then Triple QI was down 20.55%. SPY is one that continues to impress here, guys. They overall have not been around for too long. They launched in August of 2022, so coming on 3 years here. Assets under management has rapidly grown here. They've definitely been getting some good publicity on my channel. $2.86 billion, super juicy dividend yield, and prior to this trade war talk, there was no NAV erosion. Of course, dropping 17% since the last 2 months definitely hurt this fund, as with basically the rest of the stock market. That will do that for sure. When we look at its dividend history, we can see so far for the year they paid out 51 cents or 52 cents, 51 cents, and then back to 51 cents. Love to see that consistency. Hopefully over the long run it will continue to grow, and that does seem to be SPY's history. They did initially start closer to around 46, 47 cents. So even to see it go up just a few cents over the years, I love to see that. That's much better than what we saw earlier with ETFs like FEPI, AI, PI, where the dividend is actually declining over time. That's what we don't want to see. Of course, I had to make a reference to the Yield Max lovers. There will be no Yield Max products on today's list, but their flagship fund with their leader of the high yield dividend warriors is actually not done terrible. It's still somehow only down 4.49% since their inception and has paid out a ridiculous dividend yield. But you guys just wait and see. I have a feeling Bitcoin will be collapsing here shortly, and MSTR, Misty, they will all come crashing down as well. Number 2, GPIX, GPIQ, Goldman Sachs. Oh man, this fund has been number 1 for so many months, but it has finally been dethroned. Guys, this is still a fantastic fund, but number 1 was just too good. But let's talk about number 2 while we're here. This is the Goldman Sachs Core Premium Income ETF. So they're going to be doing this on the S&P 500, on the NASDAQ 100. They're looking to get current income while maintaining capital appreciation. And they definitely have been doing such a good job about this ever since they launched. They've been giving out consistent monthly distributions. They've been giving out great capital appreciation and a super low expense ratio. It really was the best of every world here. We can see even with the 17.25% decline GPIX has had since February 19th, they are still up in capital appreciation. That's how good they were doing, paying close to that 10% dividend yield, and now having nearly $500 million in assets under management. Love to see it. When we look at their dividends, we can see in 2025 so far, they paid 35 cents, 36 cents, 34 cents, and then it dropped a little to 33 cents, but still very good income for us income investors. who love to see stable funds like GPIX and GPIQ, which was down negative 22.11%. Number 1, JEPI, JEPQ, JP Morgan Chase. All right. We have a new number 1 in town, and this is not a brand new fund. This is one that's been around for almost 5 years now. That is the old reliable in JEPI and JEPQ. I'm going to talk a little bit about why I decided to rank these as the top income ETF in these power rankings, and that has to do with their recent performance. We can see here that JEPI was only down 12.68%, and JEPQ was only down 20.36%, which means they were down considerably less than their counterparts. Remember, JEPI and JEPQ for the longest time was advertising that they have all this, proprietary research and time and tested bottom-up fundamentals research process that allowed them to have less volatility. And when it came time to actually showcase this time and tested bottom-up fundamental research process and proprietary data, it came up on top. That's why I ranked them number 1 on my list. And of course, they've been paying consistent dividends, factored in with how long they've been in the game, right? This is not a newcomer. They've been around for almost 5 years now, and they've consistently paid a very good dividend yield. And we can see even after 5 years, they still have capital appreciation, no NAV erosion. I don't know if you could say this about many of these income ETFs that keep popping out left and right these days. When we look at JEPI's dividend history, they went from 39 cents to 33 cents to 33 cents to most recent month was 41 cents. So a little bit of variability with their dividend, but still pretty consistent. And most importantly, I like how they're being responsible with that dividend distribution. I love it. Now their counterpart in JEPQ will have slightly different distributions. It should be generally higher because it's on the NASDAQ 100. So we went from 46 cents to 45 cents to 48 cents to 54 cents. Love to see it. Consistent high income for us investors. JEPQ has not been around as long, but still just about to hit 3 years here, and you can see a lot of people pouring in money into these funds. JEPQ, $21 billion. JEPI at a ridiculous $36 billion. That's the reason why they're on top of the list. Of course, the big banks, JP Morgan Chase, they can do a lot more than a lot of these smaller, newer companies. But still, nothing is beating this dynamic duo in JEPI and JEPQ from JP Morgan Chase. All right, guys, what do you think of my power rankings? Are there any that you agree with, disagree with? Are there any that you think I should take a look at? Because I do not have time to go through all the hundreds of income ETFs out there. I rely on you guys to let me know in the comments below which one you guys like. Be sure to hit that like button and make sure you're subscribed because I do update videos like this all the time. My videos are always found in podcast form under the Collect Cash podcast name, and I will catch you on the next one. Continue to slay the dragon.
Risky behavior like gambling problem, party lifestyle, sexual behavior. You just go out there and party life, city girl. And taking drugs, drinking alcohols, doing all these things, sexual behavior, just